Hey, it's Neil from Toronto Condos. We are pre-construction real estate specialists. We help people buy pre-construction condos in Toronto and the Greater Toronto Area. If you're somebody who's looking for a pre-construction condo, we can help you out. What's up, everybody? It's Neil from Toronto Condos. Today, I want to talk to you about cash flow in the Toronto real estate market. That's right, cash flow in the Toronto real estate market. If you're new to the channel, I'm Neil. I'm a pre-construction condo expert. I help people buy pre-construction condos in Toronto and the Greater Toronto Area, either to live in or for investment. Also, again, if you're new to this channel, make sure that you subscribe and hit the notification bell so that you get videos like this in the future. And also leave us a comment below. Let us know what you think about real estate, what you think about the Toronto real estate market. Commenting below really helps out the YouTube algorithm, and it helps videos like this one get pushed up to the top so more people can watch them. So let's talk about cash flow. In the Toronto real estate market, people are always looking for opportunities to purchase. And the question that comes up is, does cash flow still exist in the condo market in Toronto? The answer is yes. It does exist, but you have to look very carefully. It doesn't exist on all unit types. You have to search carefully, and you have to pick, number one, the right unit, and number two, the right location. Now, when we look at cash flow, similar to any other real estate that you buy where you rent it out and have cash flow, is you have to look at what's your monthly revenue and what are your monthly expenses, and of course your revenue have to be greater than your expenses. So let's look at that. Obviously, your revenue is the rent that you're collecting on the condo. Your expenses on the condo are going to be your mortgage payments, your property taxes, your condo fees, and your insurance. So you of course have to make sure that all of those expenses that I just mentioned, your mortgage, your property taxes, your condo fees, and your insurance, all together are less than your monthly revenue, and your monthly revenue being your monthly rental income that you receive from your tenant. So when we take a look at the Toronto condo market, because prices have gone up significantly over time, and because the Toronto market continues to rise, there's fewer and fewer condos that this actually works on. So what type of condo do you target, and where can you get cash flow? Since we're pre-construction real estate experts, we know the market very well, and you have to really go in and pick generally the smallest units in developments. The smallest units with the lowest purchase price, and that you're able to get the highest rents for. When we take a look at these types of units, what are these units? These units often are small one bedrooms or studio units, where you can get your purchase price down so much that you're able to still get a decent cash flow in terms of monthly rent, and you're able to cash flow the unit on a monthly basis. Again, meaning that your overall revenue that you're collecting from your monthly rent is higher than your monthly operating cost. So let's take a look at a live example of a unit that exists right now, and let's do the analysis. All right, so let's get right into the example. So these exist, my friends. It's just a matter of you need to know where to look for them. There are not that many anymore, but you need to know where to find them. So here's one example. Purchase price 476,990. This exists. This is in downtown Toronto. This is an example. With a down payment of 20%, you're looking at a down payment of 95,398. Again, that's 20% down payment that you'd be putting down here, okay? So we're working under the assumption for the first example that you have a 20% down payment, okay? And simply put, we'll take our calculator, easy math, 476,990 multiplied by 20% gives us 95,398. Okay, so that's our 20% down payment. We'll move that over here. Next, the first mortgage amount. So obviously the purchase price of 476,990 subtract the down payment gives us our first mortgage amount, and we're going to do that again via calculator so you can see. So 476,990 subtract the down payment here gives us, we're going to subtract 95,398, gives us 381,592, 381,592. Okay, so this is what we're working with. These are important numbers for us as we move forward now and get into more of the analysis. Now, I've used a mortgage calculator, which you can Google and get a mortgage calculator, or you can have a mortgage app on your phone. What I've done is I've taken a 30-year amortization mortgage and I've taken it at 3%. These are the figures I'm using to run on the first mortgage, okay? So that's important to know. So what that gives me is a total monthly mortgage payment of $1,605 per month. So if you're following here, your purchase price is $476,990. You're putting a down payment of 20%, which is $95,398. Your first mortgage amount is $381,592. Taking a 30-year amortization mortgage at 3% gives you a monthly mortgage payments of $1,605 monthly, okay? So that's the first step that we need to do as we do our analysis to finding cash flowing condos in Toronto, all right? So we're gonna enlarge this figure here and then we're gonna move forward. Now, for those of you who aren't familiar with Toronto and the downtown Toronto condo market, don't be shocked. 347 square feet. That is correct. I know this shocks some people that live in the suburbs, but this is the reality, my friends. 347 square feet. This is a studio unit in downtown Toronto. Now, the condo fees here for this particular project in this unit are 59 cents per square foot. So we take 347, we multiply that by 59 cents per square foot, and we're going to use our trusty little calculator again, and that gives us 347 multiplied by 59 cents, which gives us 204.73. So let's round that up to 205. So what this is $205 per month for the condo fees. Okay, there we go. So this is our next important figure, which we're going to enlarge right here so we can see what that is. Okay, so you got $1,605 per month mortgage payment, and we have $205 per month condo fees. Now, for property tax, for the purposes of this analysis, we're going to take 0.6% of the purchase price of the unit for property taxes. So we're going to multiply 0.6 times 476,990. Okay, and that gives us a figure of 476,990 times 0.006 gives us this figure annually, and then divided by 12 gives us approximately $238 per month. So $238 per month property taxes. Okay, now we're going to enlarge this a little bit further as well so we can keep track of this. Now, in terms of other additional expenses, in terms of insurance, you know, you're looking at, for a unit like this, on the very, very high end, you know, not more than $25 per month. That's even a little bit too high, but I'd rather give a higher figure than a lower figure. On my units, I've got between $10 to $20 per month, so 25 is definitely a reasonable estimate. And there we go. So we've got our monthly mortgage payment, our condo fees, our property taxes, and our insurance. Now let's add these figures up. So we're going to add up this figure, this figure, this figure, and this figure. Okay, and let's see what we get. So it's this easy, right? It's this easy, but again, I don't mean to oversimplify this. You really have to know where to look at what units to buy and what sort of rents are going to yield from these units. You know, it's very difficult when you're trying to search and find this on your own. We do this every single day, so we know where these opportunities exist. So we've got 1605 plus the 205 plus we're going to do 238. And then plus we're going to do $25. Okay, so that gives us $2,073. Okay, so $2,073 per month. Now, this is our total carrying cost. This particular development is not complete until May of 2023. So by my math, that's, we're in 2019 right now. So 2020, 2021, 2022, 2023, that's 4 years, right? The rental rates for a unit like this in 4 years are going to be no lower than 2,100 per month, okay? I would even say it's possibly higher. So 2,100 per month is going to be your rent on the low end. So your rent of 2,100 per month, subtract your carrying cost of 2,073, right? I mean, I'm going to use my calculator. We can do this math right here, obviously, but I just want to show you, what this equates to. That gives us a positive monthly cash flow of $27 per month, okay? So with this simple example, we see that you can buy an existing pre-construction condo in Toronto. You can put 20% down. You can calculate your estimated mortgage amount, your monthly expenses, your condo fees, your property taxes, your insurance, and with all your expenses, factoring in the future value of when this is ready and the rental rates, which I feel this is a conservative estimate by 2023, you're $27 monthly cash flow. So that's just the straight cash flow. So we're not even talking about mortgage paydown. We're not even talking about appreciation, which we can cover shortly in this next video that we're going to record. So there you have it. You can buy a pre-construction condo in downtown Toronto, 20% down, wait, the 3-4 years, make equity, which we're going to cover in the next video, on the condo unit, and it not cost you anything on a monthly basis. So make sure that you watch the next videos on the mortgage paydown, as well as the appreciation and how you factor that into your overall ROI as well.